Hey, good morning and welcome back to the Real Estate Hour. And we are excited to have Russell Marsan on the line. And we actually, Redwood Credit Union had him presenting to a group of realtors and talking about a 1031 exchange. And because a lot of us work with investors, and there were commercial agents in the room and also residential agents, which is primarily what we do, is residential. But we were very impressed with so wanted to welcome Russell Marsan IPX1031 Exchange. Are you on the line?
Yes, I am. Good morning, Allison and Stephanie.
Good morning.
Morning.
Thanks for calling in.
Yeah, thank you so much. And we've had other good presenters and people on the air talking about 1031 exchange in the past. But what I really liked about your presentation is you talked a lot about strategy. And we often just explain what a 1031 exchange is and a little bit of strategy. But I really feel like you have a good grasp on really maximizing your investment and I forget how you put it, but kind of being in the right investment for the right season of your life, which I think is a really insightful way of looking at it. So yeah, welcome definitely. And thank you.
Yeah, my pleasure.
Yeah. So why can you tell, just kind of, I introduced you as you are with IPX Exchange. You want to tell us a little bit about who you are and what you do there?
Yeah, absolutely. So, yeah, as you stated, I'm Russell Marsan. I'm a senior vice president with Investment Property Exchange Services. We're also known as IPX or IPX 1031. We're the largest qualified intermediary in the nation. So all we do is facilitate exchanges, and I've been doing it for 29 years. I'm a certified exchange specialist, and there's less than 200 people in the U.S. with that designation.
Wow.
Very impressive.
Yes, thank you. And so just to kind of, I don't want to spend a lot of time on the basics of 1031 exchange because, like I said, we've talked about it before, and maybe who's listening doesn't really know what we're talking about. So I want to honor their being able to understand what we're talking about, but then I want to take a deeper dive on kind of some of the strategy. But can you give us kind of just a basic overview of what a 1031 exchange is?
Yeah, absolutely. 1031 exchange is actually the greatest wealth building tool in the entire Internal Revenue Code because it allows a real estate investor to reposition their real estate assets throughout the course of their life without having to pay taxes. Because as we grow in life, our financial objectives change. Naturally, it's guaranteed, right? And as they change, the 1031 exchange allows you to sell an investment property that you no longer want. It's not meeting your personal or financial objectives, and it allows you to, reacquire another type of real estate that better suits your current financial objectives. So you're listing and selling a property you don't like, and then the 1031 exchange gives you, 45 days to identify, 180 days to close. So there's this time period in between when you sell and you buy to go out and buy something that's equal or greater in value.
Right. And it's funny because I had a conversation with somebody at a networking event earlier this week, and I mentioned 1031 exchange. Actually, we were talking about the radio show, and I said, I have somebody coming on talking about, and he's all, the Starker exchange. And I go, well, that's what it used to be called. Is that kind of how it started, as just kind of a swap where it wasn't an intermediary in the middle and all of that? Or is that?
Yeah, absolutely. So, the exchange has been around roughly since 1921. It's morphed into what it is now. But from 1921 to 1979, the only type of exchange you could do was a deed swap, right? So you and I had to swap properties. I couldn't sell to one party and buy from another like we now do.
Right.
Starker it was called a Starker exchange as a nickname just because T.J. Starker is the most famous taxpayer in our world, right? He was the first person that ever did a delayed exchange and beat the IRS and forced them to create what we now have in the rules of being able to do a delayed exchange. So in our world, he's like a superhero to me. I have his poster on my bedroom wall. Right?
Well, he's our hero now, too. So.
Yes.
Yeah, and for all the investors out there that have been able to take advantage of it, right? So now it's not just a swap; it's a like kind exchange. And what I think there's a big misconception about what like kind means. You want to touch on that one?
Yeah, that's the greatest misconception of all in our world.
Yeah.
Because I'm a visual person, right? And if you
Me
tell me,
too.
the property you sell and the property that you buy in the exchange, they both have to be like kind with one another, then I naturally think, okay, well, if you're selling raw land, then I have to buy raw land. If I'm selling a rental house, I've got to buy a rental house, etc. And that's not the case. It's not what a property looks like that makes it like kind. It's how it's treated for tax purposes. Any business or investment property is like kind. So you can sell raw land. Let's say somebody out there listening now owns 5 acres of land they're doing nothing with. It's providing them no cash flow and no depreciation, so it's a negative cash flow vehicle. Well, you can free up that stagnant equity that's in that asset, and you can exchange into your first rental property, right? You can sell land and buy a rental property.
Yeah.
Now you have income
crazy.
property, right? Now you have cash flow. Now you have depreciation, etc. You can sell rental properties and buy commercial, industrial, mini storage, right? It's all interchangeable. It's all like kind.
Yeah, and I think it is. A lot of people see it. I'm visual also, so when you see like kind, I'm all, okay, I got to sell this house and buy another house like that. But I know that's not true. But I know a lot of people look at it that way. Gosh, I lost my thought. I was when you were saying that, I had a thought. As far as buying the you were saying depreciate, and usually when we talk about real estate and the benefits of owning real estate is the appreciation, which is the equity gain and the value of the house going up, but depreciation is more of a tax thing for investors, right? Where you get to take that off every year.
Yeah, it's a major tax benefit that we have in real estate. If you own an improved property, like a rental property, for example, let's say you buy a rental property for $550,000, just to pick a number.
Yeah.
And so you get to depreciate the value of the improvements, which on average is maybe 75% of whatever the purchase price was. That's the assessed value of the improvements, and then the 25% maybe the assessed value of the land. Well, that big number, you got to divide over 27 and a half years. So on a house that size, $550,000, you're probably looking at a $15,000 a year write-off, which means the first $15,000 of income from the rental property, you have this automatic $15,000 write-off to negate any tax due from that income. So yeah, it's a huge benefit for investors earning cash flow on improved property and real estate.
Right. And then after a certain amount of time, you're not able to do that depreciation. Or like when you said with land, you don't get to depreciate because you're depreciating on the infrastructure, the structures, the improvements.
Yeah,
Thank you. I lost that word for a minute. And so if you have if you've owned it for, what is it, 27 and a half years of depreciation?
27 and a half years is residential, and then 39 years is the straight line for commercial.
Okay. So yeah, if you've gotten to the end of that and you're no longer depreciating, maybe it's an underperforming investment. You want to think about exchanging into something else. Or like you said with land, where you're not getting the depreciation. So thanks for clarifying that, because I know we always talk about appreciation, and then everyone's probably not everyone, but somebody that maybe isn't familiar with investing. What is depreciation?
And so I just wanted to ask, so when does an exchange not make sense?
It's a loaded question.
I know.
Yeah.
It really is.
And realize you're asking a very biased person, right? But no, I mean, really, the 1031 exchange, the big purpose of that is the deferral of tax, right? Yeah. So if you're selling an asset you no longer want, then so really it depends on what your gain, right? How much gain do you have in that property you're selling? If you have very little or no gain, then there's no need to do an exchange, right? Or maybe if you are you have something else going on in your tax picture. Maybe you have a carry forward passive loss from selling some stock or real estate in the past that you took a loss on. Well, then you can sell the property and kind of negate that gain, write it off against the carry forward passive loss that you have. Or you need to do something personal with those funds, like you need to pay medical bills or something, right? And you don't mind paying the tax, right? There's no right or wrong, but it's just a matter of really looking at that number and I always tell clients, hey, they're questioning whether or not talk to your tax advisor, find out what that tax hit is first, right, before you sell, and that way right? Because a lot of people think I'm just going to pay like 15%, and the reality is in California you pay closer to 35%. So know what that number is, and then make your decision on whether you should exchange or not.
Okay.
Yeah, I think that's a good point.
Yeah.
And then you can do a partial exchange too, as far or not. Yeah, so where you can take some of the money and pay the bills you need to pay, and then exchange the rest, right?
Absolutely. Yeah, it's not an all or nothing thing.
Yeah. Okay. So it's all taking a look at it. Is that something that you? I mean, I know it's always talk to your tax advisor because neither you or I are tax advisors. But I think as an exchange intermediary, and especially, I think you have a really good grasp on strategy from my conversations I've had with you. Is that something that you kind of can help somebody understand different directions and what makes sense for them?
Yeah, absolutely. So, I'm a student of the business, and not just 1031, but everything around it, all real estate tax law. I teach accredited courses for CPAs and attorneys. So I'm a free resource for all of my clients, legal and tax advisors, too. But yeah, I mean, as a qualified intermediary, I can't act in an agency capacity for my clients, so I can't be their attorney, their CPA, their broker, right? But I can tell them, hey, here's how all the different tax rates. I can help them to come to that conclusion of what their tax rates are, and then also help them to determine what all of their various options are.
Yeah, I think that's great, and it's good to have somebody. And just to what an intermediary is, and when you're doing an exchange, you sell one property, then the intermediary holds those funds until you find that other property exchange or properties. And Stephanie had a question about that.
Yeah, so can you talk briefly about the strict timelines?
Yeah, absolutely. So timelines for a 1031 exchange don't begin until the relinquished property, that's the one that you're selling, actually closes escrow and you no longer own it. That starts the clock. Now, let me be very clear to our listeners out there. You have to set up the exchange before it closes.
Yes.
Right? You cannot close a property and then do an exchange. It has to be in place.
Right, and the money can never go into your account, right? Into your personal bank account.
Well, not even that. They can't even have control of it. So let's say escrow closes today, and then tomorrow they don't go in to pick up the check, so they don't physically have the funds. But still, because of the fact that they can go in and pick up the funds, they have constructive control of funds, right?
Okay, yeah.
So so it's not physical; it's constructive, or physical control of funds.
Oh, good. Thank you for clarifying that, because I always just say it can't hit your bank. I mean, knowing, sometimes we just throw out things because we know what we mean, but that's a good, better way of explaining it. And it can't go in your bank account.
Good point of clarification.
But sorry, go ahead.
Once it does close, that starts the clock, right? And that starts the 45 days. You have 45 days to identify, just name whatever properties you want to buy. And then you have a total of 180 days to actually close escrow on whatever you want to buy. So you get a month and a half to find them, 6 months to close on them. But you don't have to wait. And I really want to stress this to everybody out there. Do not wait until the property you're selling closes to begin that process of writing offers and looking for replacement properties, right? You want to be in contract on a replacement property before day 0 to help your exchange, not fail. Don't flirt with that 45-day identification.
Right, and so many times we see agents, pitching on different groups that we belong to, or, it's like, oh my gosh, we need to close and, we need to identify in a week. Like, there are some strategies really as the listing agent to say, maybe negotiate in the contract. We're gonna, if you don't mind, we need to do a longer escrow so we can identify something, or we don't want to close. And sometimes if you find a buyer who is flexible like that, especially if it's an investor, unless they're in their own exchange timeline, but it's all about strategy, right?
Yeah, definitely.
Oh, 100%. Yeah, I mean, because you can do things exactly like you're alluding to, where you've got a buyer for your relinquished property, and you tell the buyer, hey, we don't want to actually close this until we're in contract for our replacement property. And so, hopefully if they work with you on that, because you're postponing the clock starting. Yeah.
And I mean, that's I think one of the most important things, especially in a hard market where, when you might identify 3 properties in that 45 days and then none of them go through, and once you've passed that 45 days, you can't add it. You can't re-identify anything else, right? It has to be in it.
That's correct. That's correct. Yeah, as soon as midnight strikes on day 45, you're locked in. You can only close on one or more of the properties you've identified. You can't substitute new properties after day 45, no matter what has happened to those properties.
Yeah. Yeah. So that's a good segue. We're going to take a quick break first, but I want to talk about the DST, or Delaware Statutory Trust, because I think that that's a really good fail-safe to maybe put as one of your three properties to identify, because if you have that ready to go and the other two don't pan out and you're out of time, you've got that. And there's other good reasons why the DST is a great tool for investors, maybe that have timed out on, or they just are tired of being a landlord, I think it's another very little known and understood product that can be used as a 1031 exchange. So if you don't mind, we're going to take a super fast break, and when we come back, let's dive into the Delaware Statutory Trust. We're talking to Russell Marsan with IPX1031 Exchange, learning all about what a 1031 exchange is and how to use it as a tool in your investment portfolio. I'm Allison Norman.
I'm Stephanie Norman.
We're the Norman Home Team, and you're listening to the Real Estate Hour. We'll be right back with Russell Marsan. Good morning.
Good morning.
Welcome back. We're going to talk. We are talking. We've been talking kind of basics of 1031 exchange. I want to take a deeper dive now and talk about some strategies. We've got Russell Marsan on the line with IPX 1031, is it just IPX 1031?
Yeah, IPX 1031 is fine.
I always want to add that exchange in there. And IPX 1031, talking all about 1031 exchange. Like I said, I think what I like a lot about you, Russell, is that you seem to have a really good grasp on strategizing and finding the best opportunity for an investor that maybe is in the wrong investment for this season of their life. So two things that we've talked about, and you talked about in the event that I went to where you're speaking, was using that Delaware Statutory Trust, or DST, as a strategy to, one, like I mentioned before we went to break, to have that as a fail-safe, as one of your identified properties in case the other two didn't go south, but also then as a really tool to get yourself out of the landlord business if you're tired of being that type of investor, real estate investor. So what can you tell about kind of what is a Delaware Statutory Trust and why it's a great tool?
Yeah, absolutely. So let me back up, because I'm going to tie into what you kind of first opened the show with when you're bringing me on.
Perfect.
And that is, people's different objectives, right? What I find is that people with assets, right? Let's say somebody's at retirement age. Well, they have a stock portfolio. They have a 401k IRA. They have real estate, right? And they have an Edward Jones guy or a financial advisor that actually, helps them every year to make sure that they're in the right stock, both in their 401k, their IRAs, all that stuff. But they don't have somebody doing that for their real estate.
I agree.
And so, because the Edward Jones guy is not going to do that for them. They don't deal in real estate. So what happens is people buy and hold the same real estate their entire life, which is wrong. You wouldn't do that with stock. You shouldn't do that with real estate, because your financial objectives change. And most people get into real estate buying single-family type properties when they're young, which is perfect, because that's a phenomenal way to build long-term wealth, is to buy and hold single-family. You'll amass a lot of wealth if you hold it over 2, 3, 4 decades. But later on in life, now somebody owns, they're a baby boomer like myself, and they own 4 or 5 rental properties free and clear. Well, they're in the wrong asset class. They're in an asset class that's designated for appreciation, not cash flow. Cash flow on rental properties, from a financial analysis standpoint, is poor. It's not good at all. So you've built equity. At retirement age, now it's time to put that equity to work for you and go into an asset that's better suited for cash flow. And then there is what you mentioned, getting out of real estate, the headaches of real estate. That's the secondary objective as well, passive, right? If I've owned rental properties my whole life, I want to get out of them. I don't want to deal with them anymore, but I don't want to pay the tax. And that's where the DST comes into play, the Delaware Statutory Trust. It's the most passive form of ownership in the real estate world. When I buy into a DST, and by the way, it was approved by the IRS 21 years ago as like-kind replacement property. So there's a lot of history in our world of the DST.
Yet a lot of people don't know about it.
No, not at all.
Definitely.
Yeah. When you buy into a DST, you're buying $150 million Class A asset somewhere, like an Amazon distribution center or something, right? You're just a passive owner in that investment. You simply receive income every single month with zero duties or responsibilities. And there's no cash calls allowed, which means that if, they have to replace the roof, they can't ask the owner. So there's no outflow for maintenance. So it is literally just passive cash flow every month. There's really three reasons why people do DSTs. You mentioned one, and that is a backup strategy or a bailout for their 1031, right? They couldn't find something, so at the last minute, before day 45, they identify a DST. Because there's always between 30 to 50 different DST offerings that are open and available, and they're typically open for 2 or 3 months. Also, to retire from active real estate, because I want to go passive. And then the other one is as a sponge for their 1031. What I mean by that is they sold for $2 million. They found traditional real estate for 1.7. What are they going to do with the other 300,000? They want to buy a rental house. Okay, great. Throw it into a DST.
Okay. Yeah, I mean, it's such a I don't know if it's underutilized, but I think just a lot of people don't know about it, and it's crazy. It's been around for
undereducated
for 20 years, and so there's something with the loan where you get kind of double the value on the loan.
So most DSTs are leveraged by about 50%. So when the company that owns and manages that property, when they originally buy it, they buy it with their capital. They put about 50% in, and they get a loan for 50%. That's an approximate, right? Mm-hmm. And then they close the transaction, and then they put it into this DST ownership structure and sell out, 90% interest or whatever it is, right? So anybody that's buying into a DST is, if they're bringing in $500,000 of cash, they're buying $1 million slice of the DST. So if somebody you mentioned depreciation, if somebody's owned a rental property for 30 years and fully depreciated and they run out of depreciation and they sell a property for $500,000, well, when they buy into a DST, they're buying $1 million piece of that DST, which means they get $500,000 of brand new depreciation to start taking over 27 and a half years again.
Yeah, that's a crazy benefit.
Yeah, it is. It's wonderful.
Definitely.
Yeah. So it's just something that I really think people should look into, especially if you've gotten to the end of that depreciation on your long-held rental property, or the one thing for the kind of a placeholder for that fail-safe backup is that there is a time. How long? Usually the STs are like 5 to 7 years. You have to hold them.
Yeah. Well, you don't have to hold them. They're going to have a natural life cycle, right? Because they're going to be resold when the market's right, and they're going to sell the asset for a profit. They sell it, and then all of the owners get that appreciation as well, and then have a 1031 opportunity to go into another DST or do whatever they want again, right?
Okay.
With the newfound capital, but 4 to 7 years is kind of the average hold time before it sells.
Okay. Well, I mean, I think it definitely, and you can recommend if somebody calls you and says, hey,
Sure.
I'd love to hear more about that. You can talk about that, and you have people. It's a different, but there's people that actually do the DST that you refer to, right? Yeah.
They're licensed. Yeah, they're regulated by the SEC, so they're only sold through licensed financial advisors.
Okay.
That specialize in that asset class. But let me make one little point to the listeners out there. Mm-hmm. And what I'm about to say is math. It's not sales. If somebody is of retirement age and they own single-family rental properties, you're in the wrong asset class. It's just that's a math equation. Mm-hmm. It's not sales, right? So you really need to investigate your options and see what else there is out there that can give you better cash flow and allow you to go passive.
Yeah, and I mean, I'm all about passive income, and that's the ultimate goal. I think one to avoid the taxes, but also to build your portfolio, whether it's real estate or anything else, but to build to the ultimate goal, and for me anyway, is to have that passive income. So when you're at retirement age, you're receiving income for doing what you did previously. Right. We're gonna have to run out. I want to make sure to get your information out. I had another question for you, but let's first talk about how somebody can get a hold of you, so we don't run out of time for that.
Yeah, cell phone number is the best way. Area code 530-755-8355 is my cell phone number, and then they can Google my name, Russell Marsan, RussellMarsan, and you'll see all kinds of results. I'm out there in the web.
Yeah, and you've got a lot of really good informational videos on your website as well. And we'll put all that information on the Facebook page, Real Estate Hour with Allison and Stephanie Norman. And we're not going to have time. I wanted to talk about transferring a primary to a... We're not going to have time, but it's a good...
Buying a primary residence with a 1031.
Right, yeah, or doing that partial where if you have a workspace in your home that you're claiming on your taxes.
Mixed-use exchange.
Exactly.
Yeah, if somebody's claiming an in-home office, you need to give us a call.
Yeah, so give Russell a call, because all of what we didn't have time to ask him, he's happy to chat with you about. Also, we'll give out that website on the podcast and on Facebook, and that'll let you know what give you some good advice there too. But we got to go. Russell, thank you for calling in.
Thank you so much.
Great information, and have a great rest of your weekend. Take care.
Bye.
All righty, you guys, all you veterans, have a great day. I'm Allison Norman.
I'm Stephanie Norman.
We're the Norman Home Team. You're listening to the Real Estate Hour. Come out and see our open house, 2024 Knowles Drive, 1 to 4.
You've been listening to the Real Estate Hour with Allison and Stephanie Norman, the Norman Home Team on KSRO.